From the library of the New York Stock Exchange at the corner of Wall and Broad Streets in New York City, you're inside the Ice House, our podcast from Intercontinental Exchange on markets, leadership, and vision in global business. The dream drivers that have made the NYSE an indispensable institution of global growth for over 225 years. Each week, we feature stories of those who hatch plans, create jobs, and harness the engine of capitalism. Right here, right now at the NYSE and at ICE's exchanges and clearinghouses around the world. And now welcome inside the Ice House.
Welcome inside the Ice House. I'm your host, Pete Ash. I must admit, I was up late last night. Me, being a huge soccer fan, could not turn off the ESPN and Fox Sports branded MLS is Back tournament, especially given the sports-deprived times we found ourselves in due to COVID-19. Over the past few months, live entertainment demand has been high and the supply has never been lower. And it's not just me. In the world of digital content, live sports dominate the ratings and garner growing shares of advertising dollars. Soccer is now the fourth most watched sport in the United States. And if you look beyond the domestic market, it is the largest sport with the most recognized teams and athletes by far across the globe. Soccer, with an endless source of live entertainment from dozens of leagues competing for the eyeballs of an established base of global consumers, combined with a clear open plane for growth here in the United States, is far from overbought. Unfortunately, with a few notable exceptions like Manchester United, that's NYSE ticker MANU, there are few ways to invest in the beautiful game. That brings us to our guest today, Roundhill Investments CEO and co-founder Will Hershey, who saw all the same playbook happening in another sport filled with lots of public companies that, by the numbers, though he would caution us, is not quite apples to apples, is already larger on the global scale than American football, and like soccer, is only starting to make inroads in the American market. In 2019, his firm launched Roundhill BITKRAFT Esports and Digital Entertainment ETF. That's NYSEArca ticker NERD or NERD, to allow investors to gain exposure to this growing collection of competitions, leagues, and the technology driving them. The return of sports has also injected life and action into sports betting, now legal in almost half the states in the country and across the globe. But don't worry, Roundhill Investments has that covered as well with Roundhill Sports Betting and iGaming ETF. That is NYSEArca ticker BETZ or BETZ. Our conversation with Will on online gaming, esports, and how Roundhill Investments created ETFs to capture the potential growth in these spaces will be coming up next.
In our time of greatest need, we want to thank the true heroes around the world for stepping up, for taking care of us, and keeping us safe. With your expertise, your commitment, your sacrifice, and your selflessness, we'll work together to create a brighter future, and we thank you for reminding us what really matters. From all of us, thank you.
Our guest today, Will Hershey, is the CEO and co-founder of Roundhill Investments. Before founding Roundhill in 2018, he served as the head trader for Yorkville Capital Management. Prior to that role, he was with Yorkville ETF Advisors, where he was instrumental in the creation and growth of 2 NYSE-listed ETFs. Welcome inside the Ice House, Will.
Thanks, Pete. Great to be here.
So we've been starting all of our podcasts asking our guests how them and their companies have transitioned to remote work. But Roundhill Investments was already fully remote before this began. So is that a result of being still in the startup phase or a decision you'd like to run the company long term?
That's a great question. I think it's probably more being in the startup phase, but also being 2 young guys that started a business. It just so happens to be in financial services, but I think we have an approach that, look, as we continue to grow, as we bring more people on board, we're going to hire the best people wherever they happen to be. And look, we're doing this remotely right now. Like you can really be efficient no matter what market you're in, whether you're even trading, right? We had the floor of the exchange closed for, a couple months and things went seamlessly. So I think it's just kind of the way the world is right now, and don't want to bash commercial real estate, but I think it might be kind of the way things go for the next few years.
But Roundhill did launch an ETF into the remote economy. Did the pandemic play a role in both the timing of when the launch was? Were there any difficulties to get approval with offices shuttered?
You're referring to the sports betting and iGaming fund that we launched in just the beginning of last month, the beginning of June. And it's interesting because we started the process for filing that fund in March. We started kind of coming up with the concept and the index underlying the fund in the beginning of the year. Then as we're going through this process with life as normal, March happens and there's no sports on TV, and we're getting calls like, hey, do you still want to go forward and launch this fund? And we're like, yes, this is a long-term story. We believe sports will come back. And really the timing, I think in a lot of ways was really fortuitous, but clearly in an ideal world, at least in our minds, we would have launched with sports being on. But the fact that we're kind of capturing this shift from physical to digital, that also plays into our other fund as well, really is something that we're big believers in over the long term.
And even with no traditional sports going, there were a lot of things going on in the betting world. There were a number of states legalizing sports betting. DraftKings went public. Penn National Game bought a stake in Barstool Sports. When did you first realize, though, ahead of this, that this would be the thematic of your second ETF?
We had been working on kind of the concept for the product dating back to the beginning of this year, the beginning of 2020. But the DraftKings going public that you mentioned really kind of was that seminal moment for us when DraftKings was acquired by a SPAC, merged with SB Tech, to kind of create the first true, in the US anyways, true online focused, pure play sportsbook and iGaming company. And for us, kind of having DraftKings out there as a cornerstone for what would soon become the index construction and then the ETF construction, to us really is important, because I think at the end of the day, investors in an ETF are buying into the underlying companies, and having DraftKings in there really allowed for us to tell a story that was more US centric. I think a lot of the companies that are in the portfolio that have been public for a longer period of time are outside of the US, even though they're doing some really interesting things, especially in the world of iGaming. Having those kind of companies in an ETF that people recognize, they understand, they've seen the DraftKings commercials, helps just from a marketing standpoint, but also helps make it a better product, make it a more pure play product, which is what we're always going to try and achieve.
You mentioned a lot of the companies are outside of the US. Do you think that's why there were not other ETFs in this space? Or do you think some of the larger firms are still a little bit struggling with combining betting and equities?
I think it might be the latter, but really I think what we're always going to try and do with our funds is really not be early, because you never want to be early to a trade or a theme, but really capture the inflection points in given markets. And we had seen regulatory momentum over the past couple of years, starting with New Jersey, which has really kind of been at the forefront of legalized sports betting, and now iGaming, which is online casino for those that maybe aren't so familiar. So really it's kind of more the fact that I think we tend to be on the cutting edge when we look at putting products out there. I think when we put out our esports fund last year, that was maybe a little bit new of a concept to the North American market, huge in Korea and China. So that's kind of the way we're going to approach it. And just coming back to your earlier question or point you made of people betting on different things while traditional sports are sidelined, esports betting has totally taken off. And I think bettors are going to bet, and they're betting on League of Legends and they're betting on Counter-Strike, just like they were betting on the NBA. And the other kind of crazy little niche that's developed, and I don't know if that one's here to stay, but is Eastern European table tennis was what had the betting world going crazy, because why not, right?
Hey, I mean, if you need to find the action, you'll find it wherever you can get it. How is the early assets under management for BETZ going? Has it been what you expected?
I would be lying if I said I expected it to grow this quickly. So maybe not surprised at the amount of assets. We're sitting at around 90 million in assets under management right now. But really the speed with which it came out the gate in the first couple of weeks and really got to that amount. To give you a little bit more context there, the ETF, and from my experience in ETFs, I'd never seen this. The ETF had something like 125 creation units in a single day, each at 25,000 shares. So we had about $50 million in assets come in effectively in a single day. And I had never experienced that in my time previously launching ETFs. And I think a lot of it was right place, right time. We talked about people really kind of emotionally being attached to the return of sports. How do I kind of invest in what I'm kind of believing in that's going to happen, and then benefiting from that financially? I think it really played into that. And anecdotally, what we saw on Robinhood, which everyone loves to talk about nowadays, I think that whole story is kind of overblown in terms of their impact on the market. Nonetheless, we had about 20,000 holders on Robinhood for BETZ within the first couple of weeks, which I think speaks to really connecting with a younger investor base, a younger demographic that we're going to try and go after with our funds, because we think it's really an area that's potentially being underserved. by other broader ETF issuers.
So we're talking a little bit about your experience in ETFs. How did your experience with Yorkville creating sort of traditional MLP ETFs and trading them prepare you to run your own firm?
I think it taught me a lot of what I wanted to do and a lot of what I didn't want to do. The didn't want to do was pretty clear. Most recently I was the head trader with Yorkville for an long short MLP hedge fund and didn't really see pipeline assets as what I believed in as a relatively younger guy as the way of the future. So that was kind of going to be a no for me. But what I really did learn was we were a small team back then, and we were able to grow ETF assets under management to 400 million in our two funds, and really got to understand the ETF business model, how indexes are created, how ETFs are marketed. Because at the end of the day, really, the ETF business, if you're talking about passive management anyway, which is what our funds are, is really that of a storytelling and marketing business, right? How do you tell people that this product makes sense as a part of their portfolio, and how do you reach a broad audience in doing so? I think I learned a lot of that from my time there. I think I was a trader too, and that was kind of like, you could see the writing on the wall that became a little bit more glorified button pressing. Am I really having that much of an impact? And said, I got together with my now co-founder, and I said, look, I think ETFs are a great scalable vehicle that can make a lot of economic sense for us and can make a lot of sense for people in their portfolios. Even though there's thousands of them, many of which are listed with you guys, there's room for differentiation and there's room for connecting with an audience in a really different way. And I think that's one thing we've really taken to, is getting in front of a younger audience by making ETFs relatable and telling the stories on platforms they're familiar with, like a Twitter or like via our blog posts and things of that nature.
So you mentioned, the good story. So when you're telling the story of Roundhill, does it start with a couple late night beers at Vanderbilt University, or did the idea of working together come together over time?
It's funny. So yeah, Tim and I have known each other for years, went to Vanderbilt undergrad together. I think the actual genesis for how we said we want to do something and go off on our own, Tim was with Wells Capital on the West Coast at that time, trading investment grade credit, it was actually during crypto. And I want to lie to you and say that like we were so intellectually curious and like how blockchain worked. No, it was like we were obsessed about the movements in price in various cryptocurrencies. And that reconnected us after, Tim had moved out west several years before. And that was kind of the genesis, was bonding over cryptocurrency. And that got the kind of wheels in motion for thinking about financial products and what we could do. What
was the point where you said, okay, we got to do this. We got to leave our jobs and we got to start this?
Oh, that's a great question. I had actually left my job a couple months before. So really not being very productive at all, apart from kind of thinking of these new ideas. I think we really decided we wanted to do it when we had identified that we thought esports was a really exciting emerging market. You had Ninja and Drake streaming on Twitch for hundreds of thousands of people. Fortnite felt like it was like it had a place in mainstream culture for a period there. I think really once we had that first product that we knew we wanted to go out with, and we had the ticker that we ended up with, Nerd, which is we're ETF nerds and we're gaming nerds ourselves too. So it was perfect. It was really when we had that product, we said, we want to go do this.
So as a Mets fan, I can't believe I'm saying this, but I've heard you speaking about how the Wilpons may have played a small role of inspiring what became Nerd. What did the Wilpons buying an Overwatch team mean to you? And then how did you then translate that into actual investor access?
Well, we'll see if they stay involved with the Mets for too much longer, right? Because we've got some rumors of some bids out there. We'll see what happens. But they did take a stake or they bought an Overwatch League team, which is an Activision Blizzard owned esport. We also saw the likes of Bob Kraft get involved with an Overwatch team. And I think really, you can't buy directly into one of these teams, which are kind of the premier or glam type assets in the world of esports, very analogous to traditional sports. But I think really what we saw was a lot of excitement and interest around the announcements of those investments, but wanted to find a way to really democratize investing in esports for the average person. Now we can only invest in what's publicly traded just by the nature of being an ETF and having to maintain liquidity. And those are great parts of the ETF structure. But we said, how can we, in the best way possible via public markets, really provide people a way in?
I was looking at the Roundhill BITKRAFT Esports Index, and it actually brought me back to October 2017 when C Limited, NYSE ticker SE, raised $884 million for its IPO. And the reason why that's always stood out to me is it was an IPO that the entire New York Stock Exchange Asian-based team was so excited about, and most of us had never heard of before, and here it's raising almost $1 billion. I was trying to look back. I could only see, I think it was the first quarter after the index started, but it looked like C was in that originally. How does your index identify a company that, like I said, very few people had heard of when it's raising almost $1 billion?
Yeah, and C is still in there now, so it's one of the top holdings. Fascinating company we could talk about for a while too. But really what we do is we utilize a keyword screening approach to try and identify companies. And we're not actively managing the portfolio, so we're not trying to pick winners and losers based on fundamentals or technicals, but really identify which companies, in the case of this fund, are most tied to esports and digital entertainment. And we get there by screening publicly related filings for different keywords. So you can imagine a keyword is esports, a keyword is video game streaming. And that really generates for us the framework with which we're then able to select securities. And taking that a step further, really what we do, which I think is important and really different and passes what I would call kind of the sniff test, is we're also trying to, as best we can through this scoring methodology, assign higher weights to companies in our given themes that are really providing you that exposure. I always like to use the example of buying Amazon to get esports exposure just because it owns Twitch, which is the largest game streaming platform in the West. If Amazon shut down Twitch tomorrow, the stock might even go up. So I think that's something that we've done that's really different as well. That
actually brings us to a tweet you did recently along this lines, and I will quote your own tweet to you. There are many thematic funds that count Microsoft, Apple, NVIDIA, Amazon, Facebook, etc. as top 5 holdings. These are not true thematic funds. They're benchmark replicating strategies with catchy names. Make sure to research and understand what you're paying for. So the fact that most of these sort of FANG stocks show up on all these thematic ETFs, is that why you realized you had to be both an index provider as well as the ETF provider?
It definitely played into it. And I think controlling that part of the equation, I mean, it's so important. At the end of the day, an ETF is only as good as the underlying, whether it's delivering on its strategy by selecting the right companies for its portfolio. And whoever said that, whoever tweeted that is a smart guy. I agree with him. But in terms of what I was referring to there, it's not that tons of thematic products hold a Microsoft or an Apple or an Amazon. It really comes back to this weighting concept. I mean, if you want to use an example of an autonomous vehicle ETF that holds, let's say, Google, because it invested a lot of capital into Waymo. And having that as a top weighting for me really misses the mark. Now, I'm not an expert in that space. I couldn't name to you which company should be at the top of the list. But it's really more so the concept of, one, giving people what the sticker, if you will, says they're getting. Are people who maybe aren't doing all the research on the underlying companies, when they buy into our esports fund, are they getting a fund that's going to benefit as esports as a whole thrives and vice versa? That's really what we believe our job is. And then taking that to one more step further is a lot of these thematic funds that I have take issue with are ones who are really kind of investing in these the FANGs of the world and companies that they hold elsewhere and charging a premium rate for something that doesn't walk like a dog and doesn't talk like a dog. It's the S&P 500 in a different wrapper.
So, I mean, education obviously plays a role in that, and using my personal experience with C as a sample size of 1, how important is it to educate potential investors in these ETFs on the underlying companies, and how do you accomplish that?
I think that's always going to be an uphill battle. And at the end of the day, some investors may simply not care. I think for some investors, they're entrusting the ETF issuer to do a good job and to select the proper securities, and they're comfortable in that position. What we believe is particularly for younger investors, and this goes beyond financial products like ETFs, but just younger generations of people are accustomed to learning at the very basic level, learning about things on the internet on their own. And I think we try and lean into that fact and have our ETF really be bought, quote unquote, rather than sold. And the way we try and go about it is we're doing a few things. We're writing a newsletter every week that talks about what's going on with the companies in the portfolio. We're putting out blog posts from time to time talking about trends and looking at it through the lens of the underlying companies. And we're also actually just started a new series where we're doing company pages where we look at an individual company and try and describe what they do in a way that really makes sense. And I think ETFs are just a wrapper, and the really interesting stories are the stories about the underlying companies that make up the ETF themselves. And that's part of what we try and do, is tell those stories.
I was struck by a conversation you had with Austin Lieberman on the 7 Investing podcast about 2 things. First, you talked about Counter-Strike, a game that my freshman year roommate played endlessly 2 decades ago, and that it was still going strong was insane to me. But also that how game companies have evolved into what I think you said the term GAAS, games as a service model. How does this change in business model help game companies not just grow, but build a captive community?
Yeah, at its core, games as a service has really been driven off of online gaming in its essence. And when I was growing up and playing Nintendo 64, or even before that, Super Nintendo, you went to the store, you bought the physical copy of the game, and if you were lucky, you had 2 controllers and could play it with your brother or friend or sister or whatever. Now what we have is, and the content that you were able to consume was exclusively what was on that cassette or disc. Now what we have is the ability for intellectual property that these game publishers and game developers have to be continually updated via the internet and via patches to the players and to the users. And really what this has done is, talking about a game like Counter-Strike that's been more than a decade in terms of really being popular and actually growing. Like, I think it just hit its higher user base ever in the first quarter this year, which is incredible. Really, they're able to engage an audience by being, one, free to play has really become a big shift in the industry. Is games companies are monetizing actually inside digital economies and virtual economies that take place within the game. And that could mean buying a new outfit for your character, or if it's in Fortnite, buying a new dance. That's one. And 2 has really been this concept of gaming as kind of more of a social medium than it ever was before. And people wanting to come back again and again to the same game to play with the same friends, and how game companies can monetize there. And really what it's done for, I believe this is what's driven a large part of it. You could also say that digital as a distribution platform is actually much higher margin than physical as well. What it's done, if you look at Activision Blizzard or Ubisoft or Take-Two, is over the past, call it 10 years, as they've shifted towards this more digital games as a service, continuing to iterate on the same IP, is it's resulted in higher margins. So EA, for example, I think over that time frame is up like 15% in terms of gross margins, and that's meant higher multiples, because if I can produce one Counter-Strike and then monetize it year in and year out, again and again and again, whole lot more attractive business model that looks something like software than if I released one Counter-Strike. Now we've got to put in hundreds of millions of dollars to develop the next one, and so on and so forth. The exception that you see this rule, although I think a lot of people would be more happy if EA did more with their sports games, is if you ever played Madden, or FIFA, they're releasing a new copy every year, versus what would be kind of this games as a service is we just have Madden, and as new players come into the league, we push that patch into the kind of to our users. So a little bit of a different approach there, but it's all resulted in a much more attractive, I think, business model for the game publishers.
It's so interesting because you think of Madden doing that would make it seem more like the actual sport, where every year they bring in a couple new players and they re-go with the same teams. After the break, Will Hershey, CEO of Roundhill Investments, and I will discuss recent developments and the growth potential in esports and gaming. That will be coming up next.
Advancements are coming. Equity and fixed income ETFs are poised for continued growth. And ICE ETF Hub is ready to advance the ETF industry. Simple, efficient, transparent. Get involved.
Welcome back. Before the break, Will Hershey, CEO of Roundhill Investments, and I were discussing the founding of his firm and the creation of Roundhill's first ETFs, Nerds and Bets. I want to go back to something I mentioned in the introduction, the value of live entertainment to attract advertising and sponsorship dollars for the teams, the players, and even where the events are being hosted. How does esports and gaming compare to traditional sports today? And what is the terms of projected growth of how much advertising dollars can esports really handle?
Oh, that's a great question. I think at its core, what you're dealing with an esports audience is a much younger audience, age demographics that tilt something towards 18 to 35, skews more male, at least in the North American market. If you go to Asia, it's much more split on a gender basis. But these are digital natives that have grown up not paying for content on the internet. And I think at its core, that creates just a need for a different mechanism when it comes to monetizing content. And throughout a large portion of the history of esports, I mean, going on Twitch and watching a stream is free. All you need is an internet connection. Very different from, large TV deals that have kind of paved the way for traditional sports. So I think there's a couple ways of looking at it. But in terms of media rights, forgetting about advertising for a second, we've already started to see on the individual content creator level, we consider this esports. So I'm talking about Ninja, who a lot of people have probably heard of, Fortnite gamer, there's Shroud. These individuals have started to sign exclusive deals with the streaming platforms themselves, whether it's Twitch or YouTube. Just came out that Ninja actually was just bought out of his contract, and it ended up he got paid $30 million in a single year. Now we're talking like contracts and salaries that look and feel like they're at the level of the big leagues. So that's one. Two, we're seeing that play out in proper professional esports. So there's a nuance there where content creators are these individual personalities that people want to watch on these streaming platforms. Maybe they're great at the game, maybe they're just okay, but these are people I want to watch. On the traditional side, I think you have a model that's shaping up to be more like traditional sports. Activision Blizzard recently signed a deal for their esports for an exclusive with YouTube. So you can only watch Call of Duty League on YouTube now. You can't watch it on Twitch. Those types of deals, I think, are going to be really important longer term. And for the platforms, it brings more users and more stickiness if they have high quality content to show. But I think when we look at the size and growth of what this industry can become, you're talking about 400 million people globally watching esports. I know that sounds crazy to us in the US because a lot of it's in China and a lot of it's in Korea, and maybe culturally we're not quite there yet, although we're getting a taste of it with no sports on TV and virtual NASCAR races on ESPN. 400 million, that's going to grow by several hundred million over the next couple of years. And I think you hit on the head of what is the biggest question for the industry is not, those are already huge numbers. It's a question of how do you best monetize? I think advertising will continue to play a role. I think media rights, like I said, are really going to be the big drivers going forward. But at the end of the day, it's a very different kind of ecosystem than is traditional sports. What you have here is you have companies, some are publicly traded on the New York Stock Exchange, that own the intellectual property behind the game. And that would be like as if XYZ company owned the game of basketball and no one could play it and no one could watch other people playing it without sign off from a company. That creates a very different dynamic and very different kind of incentive structure for who the different stakeholders are. So I think at the end of the day, the way the industry is currently set up is really in the interest of those IP holders of the Activision Blizzards, Electronic Arts of the world, because they control so much power. For the industry to really grow, they're going to need to share more and more of that pie, whether it's with players or with tournament organizers. And that's how it really takes a step to the next level.
There's something you mentioned I wanted to press on. You said they don't necessarily have to be great at the sport. So, if we're thinking about LeBron James, he's got this giant advertising contract. He has, can sell anything, but he's also the best in the world at what he does. Is that an issue that someone who, I actually am not familiar with how good Drake is at esports, but that someone like with Drake's social following can just kind of step in and already have this following and be more monetizable for these companies? Is that an issue or just how it is?
I think that's just how it is in 2020. And it's always this question that comes to mind, which is, what's more powerful? Is it the individual content creator or is it the platform? And you see this play out throughout different forms of media, right? Joe Rogan signing an exclusive contract with Spotify is kind of analogous to Ninja signing an exclusive contract with Mixer. I think it's a great thing that someone like a Drake can get on, play some Fortnite, and bring people in. I think what that really speaks to is how accessible gaming is as a form of medium and a form of entertainment, that anyone can jump on and play and have a good time and maybe even make money doing it.
So you mentioned, esports on ESPN. Do you think now that major sports leagues are starting to return, that this growth will be stunted back down to what it was, say, late 2019?
I think it's somewhere in the middle. I think when we talk about esports and game streaming, we're talking about a long-term secular growth trend that goes after the behaviors and consumption habits of Gen Z and millennials to a certain extent. So I think it's more of a generational thing. And to that extent, I think that it's going to continue on a long-term growth trajectory. No question about it. You saw a tremendous spike with, we even talked earlier about how bettors, probably who never didn't even know what games they were watching, might have been betting on League of Legends. Those types of users or viewers, if you will, probably go away. But did you bring on some new fans that really enjoyed watching what they were watching that maybe stay on? I think on the periphery, sure, but it's really more about that long-term growth. That's more generational. I don't think the guys who were watching traditional NASCAR that were then forced to watch the virtual NASCAR are going to stay with the latter when the former is back, which it already is.
So one of the things also we're talking about these companies, the MLS is Back tournament is taking place at the ESPN complex inside of Walt Disney World, broadcast on Disney-owned Fox and ESPN. All of this is the culmination of years of consolidation by the Disney company, which I should note is NYSE ticker DIS. Sony recently acquired a minority interest in Epic Game. What does that say about gaming? And do you think that there's going to be a similar sort of coming together of different players in this front as well?
Yeah, so Sony invested in Epic Games. Sony's also invested in Bilibili, which is a Chinese streaming platform. Tencent is a mega gaming internet giant in China. We're also seeing this in the world of video game streaming in the West. So you've had, YouTube really in earnest commit to their gaming. Amazon bought Twitch for almost $1 billion in 2014. Microsoft tried and failed to launch Mixer in the US. So you have big tech companies that are saying, this is a really, really valuable audience. Let's invest time and millions of dollars to try and get in front of it. Some of them have failed, but nonetheless, to me, it suggests that there's potentially something more at play here. And really, to me, it's about user acquisition and getting in front of younger people and then converting them into, potentially customers of your other, maybe even higher margin business lines. So Sony investing into Epic, I think, is really a kind of a strategic play for them. You've always heard kind of these rumors of someone like a Disney buying one of the big US game publishers. I think what we've seen is, one, a lot of these games companies are very profitable in their own right. They don't need to sell. They're producing, meaningful amounts of cash flow to shareholders. So they're going to warrant a pretty significant premium. But two, running a games company is just very, very different and a very different skill set than running other types of media companies. But I think the underlying theme is kind of legacy tech and legacy media companies are saying there's a really, really valuable audience here. One way or another, I want to try and get in front of them. And a lot of them have failed, right? Like Apple tried launching Apple Arcade that I think was a pretty big flop. Amazon just put out actually its own developed game called Crucible that no one listening to this, even if this was a gaming podcast, would have ever played. So I think that's kind of the way to look at it, is they all really want it. They're not quite sure, but they want to be involved.
Is this consolidation good with something like Kusho, which raised $125 million? I think most of that was from Google folding. And as you mentioned, Tencent being the clear winner in that one. Is that a good thing or a bad thing? Is that a maturity or is that a problem?
I think it speaks to kind of the capital intensive nature. And right now, just to be clear, we're talking about the game streaming platforms. Once again, I think that just speaks to kind of the battle that's going on in terms of customer acquisition that we're seeing play out through all parts of the economy as it relates to tech, right? It's kind of this grow at all costs, grow your top line. until the industry matures, which it has now in China, which is where Kusho shut down. And now you're starting to see winners and losers. So I think it's kind of an organic progression as industries mature. In terms of who that really benefits, certainly the content creators who are signing, and China's a much more mature market, right? So if you're a pro gamer in China, or streamer, I should say, you're signing multi-year contracts for the past few years. So it's very developed. From their standpoint, they have less negotiating power if there's only one game in town or maybe two places they can go stream, but it's definitely attractive to investors in those game streaming platforms. We're through our ETF, we're invested in Huya and Douyu, which now control a large majority of the Chinese game streaming market.
Speaking of China, in recent weeks, President Trump formed a working group to explore the risk of Chinese companies, and the Senate passed a bill yet to be approved in the House to give the Public Company Accounting Oversight Board power to audit all U.S. listed Chinese companies. This would have a market-wide impact, but does that really uniquely affect BETZ and NYSE? You said you have a lot of exposure in the Chinese market.
No exposure in BETZ, but a significant amount of exposure in NYRD, in esports, where China is one of the most developed markets in the space. It's natural that we would have that kind of weighting. I think what we're going to continue to see from kind of a de-risking standpoint is dual listings that are going to take place on the Hong Kong exchange. We've seen NetEase do it. We've seen Alibaba do it. We've seen JD.com do it. And I think that's really one of the primary risks, is what happens if you have a Luckin Coffee situation where you're kind of delisted and there's no other exchange. So I think more Chinese companies are going to potentially, that are listed, their ADRs or ADSs are listed in the US, are going to potentially look to kind of hedge that risk by listing in Hong Kong. Bilibili's already announced that they're going to potentially be looking at doing so. But from a higher level, I think that this is not going to go away overnight. And it is kind of one of those risks is really, we believe that the companies in our portfolio, even though we're passive investors, are legitimate. But that is a concern when investing internationally, especially in a place like China, where you maybe don't get the same level of transparency we're used to.
As we wrap up, your first two ETFs that Roundhill has brought to market, probably a lot because of COVID, end up being much more related than even you probably imagined. But you've said that's more of a happenstance than a plan. What sectors are you looking at? And if you prefer to keep that private, what are the broad rules that you're using to identify possible thematics?
Coming back to our earlier part of the conversation, it's always going to be about the underlying companies. ETF is just a vehicle that sits on top that is hopefully helping people by diversifying properly amongst those securities, rebalancing those securities. And that's really the value we provide and potentially if they're internationally listed, which we do, giving access to investors. Really, it's going to be about where are the companies in the economy doing the most exciting things to drive the world forward, where we think they have long runway for growth. And right now, there's kind of a couple that we're floating around. We've explored the concept of potentially doing something around electric vehicles. I think we're a bit early there, and maybe it would have been great if we launched it maybe 2 weeks ago before Tesla's run up to the moon or Mars or whatever we're saying nowadays. That was one we looked at. Another one that we've talked about, which maybe isn't more tech focused, but fits in nicely with our other two, would be a product that actually does invest primarily in sports franchises. So at the beginning of the call, we talked about Man U. You also have MSGS, which is the parent of the Knicks and the Rangers. Overseas, you have AS Roma and Juventus that are publicly traded. A lot of people maybe don't know that. So really we're gonna kind of continue to try and identify where we think underlying companies are doing things really interesting and build a portfolio from there.
We've been saying two, but there actually is a third. There's the Roundhill Acquires Deep Value ETF, and that's NYSEArca DEEP, that you, to pardon the expression, acquired through Roundhill. Was that just an opportunity, or is your plan to build out different verticals for the firm's holdings?
A little bit of both. I think at its core, our plan is to build Roundhill into kind of a diversified ETF issuer and have multiple products in the market. So from that standpoint, it fit. But really, we were opportunistic in kind of taking over this fund, which is a deep value fund focused on finding companies that are underpriced relative to their fundamentals. That's going to be different from where our core is really going to be, which is identifying these high growth areas, or maybe not even high growth areas, but areas of the market that really resonate with kind of a younger investor base. That probably shouldn't be investing in single securities, but an ETF can make sense in a small portion of their portfolio if they really believe in gaming as the future, as an example.
You made a comment recently that part of your seed funding went into investing in an app. Can you discuss that project at all?
Oh, man, you did your research here. So we are pretty early on in development, but ETFs remain our core business. One thing that we kind of came to realize over kind of the past couple of years here is how much, and a lot of this has been driven by coronavirus too, and Dave Portnoy and zero commissions, but how much education there needs to be done for young investors who are new to the market, how much maybe perhaps excessive risk is being taken by a lot of people who are new. I think that's good because you learn from your mistakes, but all things equal. So really, we're trying to build an app that potentially kind of gamifies investing, but with a tilt towards we don't want to tell people what to do, but really focuses on what they're already doing and trying to make things a little bit even more engaging and fun. And that kind of speaks to what our first two funds are, right? Esports and gaming are a lot more engaging in some ways because you can go out and play yourselves. And betting is exactly that, right? It's this gamification of another form of kind of entertainment. The market isn't meant to be entertainment. It's meant to be a place to build wealth. That doesn't mean a lot of people aren't necessarily treating it that way. You
recently posted a job looking for someone who can work on your content and marketing. And we've been talking a little bit about that historically, you guys have not done sort of traditional marketing. What is your strategy for raising the profile of your ETFs, but also Roundhill Investments as its own standalone property, besides the great hats, of course?
Well, we've got to get you a couple of those hats, Pete. Remind me after we're done here. And you kind of hit it on the head. It's going to be focused on one-to-many types of communications. And I think this is really what is so beautiful about things like social media is, as a small team, which we are, we can earn a share of voice, if you will, that's well beyond what we kind of are from kind of a human, an employee count standpoint. And we're going to continue to focus on those channels, whether it's continuing with our Twitter, blog posts, newsletters, things that we can really kind of try and educate people about why what we're doing might be interesting, and also look at kind of more traditional advertising as well. I like to highlight that for BETZ, we spent $0 in marketing and advertising and hit 90 million in assets under management in the first month. But I'd be foolish to think that there wasn't a great component of luck there. So we're going to do some of the traditional components as well. But really, it's about utilizing technology to tell our story. So
if someone listening wants to apply for that job or just keep up with everything happening with your firm, what should they do?
Pete, you're going to kill me and flood my inbox. But the best thing to do is go to our website, roundhillinvestments.com, or follow us on Twitter @Roundhill is probably your best bet.
Perfect. Thanks so much, Will, for joining us inside the Ice House.
Thanks for having me.
That's our conversation for this week. Our guest was Will Hershey, CEO and co-founder of Roundhill Investments. If you like what you heard, please rate us on iTunes so other folks know where to find us. Got a question or comment you'd like one of our experts to tackle on a future show? Email us at icehouse@theice.com or tweet at us @IceHousePodcast. Our show was produced by Ian Wolf, production assistants from Stephen Romanchik and Ken Abel. I'm Pete Ash, your host, signing off from the annex to the remote library of the New York Stock Exchange. Thanks for listening. Talk to you next week.
Information contained in this podcast was obtained in part from publicly available sources and not independently verified. Neither ICE nor its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the information and do not sponsor, approve, or endorse any of the content herein, all of which is presented solely for informational and educational purposes. Nothing herein constitutes an offer to sell, a solicitation of an offer to buy any security, or a recommendation of any security or trading practice. Some portions of the preceding conversation may have been edited for the purpose of length or clarity.